Good morning, everyone. Welcome to our Phillip Securities Research Morning Call for today. We have a few stock counter results updates. For technical analysis, we have the S&P 500 as well as a summary of the trades initiated last week. And last but not least, for our macro sector outlook, we have a few updates, including the MAC 7 monthly, Singapore Air Transport monthly, Singapore REITs monthly, as well as our usual Singapore weekly. So this slide is our usual disclaimer. The information provided is solely for education purposes and should not be considered as financial advice. With that, I'll move on. I'll hand over time to Iqbal to get us started on the MAC 7 monthly.
Thanks, Zin. I'll kick off with MAC 7 monthly. Glenn is on leave today, so I'll be covering his portion. Next slide, please. So for overall MAC 7 stock performance, it continues to recover. It outperformed the S&P 500 and Nasdaq last month itself in July. Google stock is the biggest gainer. This is because their cloud business gained quite a lot of momentum in terms of number of clients and deals being signed. For Amazon and Apple, they are the biggest laggard, but it's still positive. And this is because there's a lot of ongoing tariff concerns, and also Apple will not release any new features for the next quarter. So all MAC 7 companies net positive returns, and because of the strong earnings beat and also the investors' optimism around AI, so this fueled them to outperform the S&P 500. Next slide, please. Sorry for the background noise. Some airplanes flying. Yes. For the quarter ending June itself, this is the summary for the revenue and PATMI performance. Most of the MAC 7 companies beat and were in line with the expectations. Only Tesla missed revenue expectations because of declining average selling price and deliveries. I'll touch on this more later. As you can see, the second quarter revenue increased 13% year-on-year. So this is the highest quarterly year-on-year increase since first quarter 2022 itself. And for second quarter PATMI itself, it increased 23%, and this is the 9th consecutive quarter of growth. So this shows that the MAC 7 have a lot of revenue and earnings momentum still ongoing. Among the 6 companies that have released the results, we are still waiting for NVIDIA. But among the 6 companies, Meta is the fastest growing company, and this is being backed by rising ad price and strong demand in the e-commerce vertical. Next slide, please. So now I'll touch on NVIDIA. After the hyperscalers released their earnings, they also gave guidance on their capex. So the hyperscalers capex guidance will affect NVIDIA because NVIDIA sells their chips to the hyperscalers itself. So if you can see in the table at the bottom left-hand corner, overall the hyperscalers are more willing to ramp their capex in the most recent briefing compared to the start of the year. For example, Meta, they increased their capex guidance from 62.5 to 69 billion. So this is an increase of about 10%. For Google, they also increased their guidance from 75 billion at the start of the year to 85 billion, about a 13% increase. For Microsoft, they did not provide a very firm kind of change in capex guidance, but their tone is much more aggressive. At the start of the year, they mentioned FY26 capex growth will be lower compared to FY25, but in the most recent transcript, they said that the FY26 capex growth will moderate as compared to FY25. Also, similarly for Amazon, they mentioned at the start of the year, capex growth will be to support the growing need for technology infrastructure. But in the most recent earnings, they mentioned that capex spend will be used to pursue the unusually large opportunity that we have in generative AI. So this is very positive sign for NVIDIA because this shows that the hyperscalers are willing to spend more on capex itself. And if you can see on the chart on the bottom right-hand corner, the blue color bars represent the total capex. So this is expected to increase, even though year on year, we may see a slight slowdown in the rate of growth, as can be seen in the red line, but we do expect a positive growth. So another thing for NVIDIA is that the US government mentioned that they have to pay 15% of its revenue from the H20 chip sales to China. However, we don't think that this is very significant impact to NVIDIA because this will translate to a roughly 2% annual revenue impact to NVIDIA. And we do think that overall this is a win because having this policy means that China have access to the overall, I mean, NVIDIA have access to the overall China market, which is very big, and this will enhance their user stickiness to their CUDA software ecosystem. Yeah, next slide, please. Yeah, so I'll be covering Tesla on behalf of Glenn. In their most earnings itself, they mentioned they'll step into the India market. Currently, it accounts for about 4% of their total sales. Yeah, so they opened their first showroom and also began taking orders for the Model Y. So their Tesla Model Y starting price will be 71K, a bit higher as compared to US and China because of the high import tariffs. As for their ongoing China and Europe sales, it has declined. As you can see in China itself, the number of EVs sold declined 12% year on year. And for Europe, it also declined in the various countries. For example, Germany, it fell 55%, and in the UK, it fell 60%. Yeah, so overall, second quarter results for Tesla was a disappointment. All key metrics declined. For example, revenue, margins, production, deliveries, and average selling price. As you can see in the chart in the bottom right-hand corner, the number of vehicles sold declined year on year. And right now, as you can see, Tesla's stock price is still holding up. And we believe that this is being supported by the investors' anticipation regarding Elon Musk's return to the company, as well as the upcoming robo-taxi launch and also the full self-driving promises. Yeah, so Glenn maintains his sell recommendation and also a target price of $220. Yeah. So that's all from my end. I'll hand over the time now to Serena. Thanks.
Thank you, Yvonne. Good morning, everyone. I'm going to present Alphabet and Meta. I'm going to start with Meta first. So, the company actually announced the robust second quarter business result on 30th of July. So, in the last earning calls, Meta actually was guided a revenue between 42.5 billion to 45.5 billion. And then the consolidated revenue in the second quarter actually beats their top end guidance by more than 4%, with 22% year-on-year growth to 47.5 billion. And in terms of the segment, family of app ad revenue actually up 21% year-on-year. This is driven by a strong demand in the e-commerce vertical. As for other revenue, this business segment actually grew 50% year-on-year because of the strong growth in WhatsApp Pay business messaging and Meta Verify subscription. As for Reality Lab, it continues to report a loss making of 4.5 billion, even though the demand for AI glasses continue to increase, but the decline in the Quest sales actually offset the gain. So moving forward, we actually remain quite optimistic on Meta ad business because the comments from global marketing agency are still quite positive. They do see a global advertising spending growth to be moderated more moving forward because of the economic uncertainty, but they still anticipate a very resilient rate at 6% growth rate in 2026. This is driven by the major event returns such as a FIFA World Cup and also the US midterm election. And at the same time, they do continue to see a strong ad spending, especially in the digital marketing segment, such as search ad and social media ads. So we think Meta can benefit from this momentum. And at the same time, within Meta improvement of AI power recommendation model, where actually helps to boost the ad impression. Since brand visibility is actually one of the main focus for advertiser, alongside with the revenue generation, we think stronger demand under the better ad performance will actually shows in the ad pricing growth. At the same time, the company actually managed to present a monetization capabilities compared to the peers, where if you look at the graph at the bottom right, the average revenue per user for Meta is actually showing a positive trend on a long-term basis, while other platforms such as Snapchat and Pinterest actually continues to stagnant. We think that it could be a signal that Meta is not only performing well on the general ad business because of the massive user base, they also have a capability in precise ad targeting, which is very demographic based depending on the advertiser's needs. So for Meta, we actually maintain a accumulate rating and a target price of $830. And next for Alphabet, next slide please. Yeah, thanks. The company also delivered a very strong second quarter result. So the consolidated revenue actually up 14% year-on-year to 96 8.4 billion. This is driven by a strong growth across all the business segment. For ad business, it actually grew 12% year-on-year, led by retail and financial services, especially insurance. The result also shows a strong momentum in cloud business, which grew 32% year-on-year because the company actually managed to acquire more clients and sign more deals. So the most recent one you can see, they actually acquired OpenAI to actually use their Google Cloud services. And I think 3 days ago, they also announced Meta actually signs a Google Cloud, the 10 billion Google Cloud contract, spanning around 6 years. So moving forward, we actually think that Google's search business will actually remain resilient. Sorry, because in this earning call, we actually see some stickiness in user behavior, then actually asking for a longer and more complex query. We think this kind of data, very quality data, will actually be useful for the company to actually improve their ad targeting capabilities. And at the same time, we actually do expect user to rely more on AI generated summary, which is what AI overview is currently providing, and it will be helpful to boost the ad impression. And the strong user engagement, we think that it will lead to a increase in cost per mil, which is how much advertiser actually pay for every 1,000 advertisement actually shown to the user. But because of the shift in the user behavior, we think that the website traffic will be reduced because AI overview actually summarizes all the details and all the information that is needed. So the user might not actually click on the website that frequently. So it will put some of the downward pressure on the click-through rate, which is an indicator of whether the user really click on the ads after viewing it. But on the longer term basis, we think CTR is likely to recover because advertiser might actually start to see a very high return of ad spending under a stronger intent click, which will help with the conversion. We also do think that AI Mode, which is another product the Alphabet is currently providing, they actually do provide a more comprehensive search result to the user with the more precise ad targeting will actually help to continue to make sure that the ad pricing will continue to be competitive. So for Alphabet, we actually maintain a buy recommendation, and we have the target price of $335. And that's all from me. I'll pass the time to Fahmi. Thanks very much.
Thanks, Rina. So let's move on to Microsoft. So Microsoft released their fourth quarter 2025 results at the end of July. So looking at the performance, Microsoft revenue jumped about 19% year-over-year to 76.4 billion. This beat the consensus estimate of 73.8 billion. The business segment that was doing well was the Intelligent Cloud segment, whose revenue rose by about 26% year-over-year to 29 billion. So this was driven by the main growth driver, which was the cloud services business, Microsoft Azure, whose revenue grew about 39% year-over-year. And this is actually significantly above the company's guidance of about 54% year-over-year. The acceleration was due to the growth in the core infrastructure business coming from the Microsoft large customers. And if you look at the right chart at the right side of the PowerPoint, you can see that the relationship between the Microsoft revenue of the cloud services business and the CapEx spent over the last few quarters. So the trend is that both Azure and AI growth year-over-year are in line with the increasing amount spent on the capital expenditure. Microsoft Azure, which is in the yellow line, is growing faster on the back of the rising CapEx, where it accelerated by about 39% year-over-year in its latest quarter, compared to 35% in the fourth quarter last year. So this is the result of the increased CapEx, which is 24 billion in this quarter compared to the 19 billion in the last quarter, which was primarily allocated to the cloud and AI services. So Microsoft expects higher CapEx in 2026, but growing at a moderate pace compared to the 2025 CapEx amount. For the CapEx breakdown, that is spent on things like long-lived assets, for things like land, buildings, data centers, and some of the short-lived assets that need to replenish for in between 2 to 4 years, things like servers and GPUs, AI hardware, and they need to keep replaced. And depending on the cycle of the hardware set. All in all, we maintain a solid accumulation with a higher target price of $550, which is higher than previously $280. Despite the strong growth and the company facing ongoing supply constraint, especially in the cloud and AI capacity, Microsoft continued to guide for high aspect revenue growth of 57% year-over-year in the next quarter. And we still see some upside potential supported by a backlog of 368 billion, which is 1.3 times of last year, 2020. Over to Helena for Apple presentation. Thank you.
Thank you, Fahmi. Just quickly run through Apple and Amazon to close it off. So Apple, their third quarter revenue result was better than expectation. Their revenue grew 10% year on year, which is considered very high for them because it's been very muted growth for the past few quarters. It was mainly driven by the growth in iPhone, which grew 14% year on year, and services, which grew 13% year on year. So for their China market, has been having loss for the longest time. It actually grew 4.4% year on year, which is the first positive in the past 8 quarters. So this is driven by accelerated iPhone sales supported by Chinese government subsidies. So for the next quarter, they do expect the revenue to increase by mid to high digit year on year, and services to grow double digit. The second bullet point, Apple actually takes 5th place in the China smartphone market in the second quarter. So the leader was actually Huawei. So during the quarter, like I mentioned just now, China government is providing a subsidy for discount for the smartphone. But the thing is, it was actually, there was a price cap, so it was targeted more on the lower price smartphone. And for Apple itself, because they're from the more high end and the price is relatively higher, they actually didn't make the cut. So the earlier of the year when they rolled out the subsidy program, all the other smartphone brand joined, but Apple didn't join. It's only the later part when they realized actually other brands are getting a lot of benefit from there, so they strategically adjust their price for the new iPhone 16 series in order to make it to the price cap. So they actually benefited from the program in the second half of the year, which is why it's a little bit later compared to the other brand, which is why they slightly lose their market share a little. So you can see on the graph on the right side, this is their China smartphone market share. So we can see that Apple has been losing quite a bit ever since the 2023. So in 2023, the last quarter, it was 21%, and now they only occupy around 15% of the market. So overall, we maintain a pretty cautious view on Apple because near-term tariff headwinds do continue to weigh on their margins. And even though their iPhone sales and China market performance was strong this quarter, we expect the momentum to fade because first, the China subsidy program, it's ending soon. And also because they have a delayed series rollout, so they're really there's no major new iPhone features to kind of drive the next quarter growth. And iPhone, their own guidance for the next quarter also indicated that iPhone growth is going to be softer compared to the current quarter. So overall, we maintain a neutral recommendation with a target price of $200. Moving on to the next slide, we talk about Amazon. So Amazon, for the second quarter earnings, it was within expectation. Their revenue grew 13% year on year. The primary revenue driver was AWS, which grew 18% year on year, and advertising, which grew 23% year on year. So AWS operating margin actually compressed 2.9% to 32.9% due to heavy AI investment. A retail margin surprisingly increased 0.9% due to their efficiency improvement. They've also mentioned that they have not really seen a decrease in consumer demand due to the tariff. AWS posted a strong growth of 18% year on year. But like I said just now, the margin fell. It actually fell to the lowest in the past 6 quarters. This is due to their pretty heavy AI investment. They have guided that the next quarter capex is still continue to be high. It's going to be around $31 billion. The second bullet point, the Prime Day 2025, which happened in July, was the largest Prime Day event ever. So for the first time, they actually expanded this year's Prime Day from 48 hours to 96 hours. So it's the first ever 4-day shopping event. So the online transaction during the sale reached 24.1 billion US dollar, which represents a 30% year-on-year growth. So we definitely do continue to see the consumer demand from there. And last but not least, they're cutting jobs at AWS. They have not really disclosed the exact number of the cut, but they do stated that they're going to eliminate some of the teams, but they're going to simultaneously hire for more priority positions in other areas. So I guess all in all, we continue to see strong momentum in retail. Impact of tariff uncertainty have not yet been obvious, and with Amazon's scale, sourcing flexibility, and strategic focus, we think it's pretty well positioned to manage the macro risk. AWS demand remains really strong, driven by the rapid growth of the entire cloud industry and healthy consumer demand. So they're still seeing pretty strong backlog, which grew around 25% year on year. We view the recent margin contraction not exactly alarming because fluctuations are expected, especially when they're ramping up a heavy investment in AI. The company have also been warning by cutting jobs. So overall, we still think it's a pretty positive side. So we remain buy recommendation with a target price of 260 US dollars. Okay, remain overweight on Magnificent Seven. We've seen hyperscalers' second quarter operating margin overall still increased by 30 basis points quarter on quarter, which is the ninth straight quarter of sequential margin expansion. So the highlight would be Apple because their iPhone sales increased a lot, 14%, which is the first positive China iPhone sales in 8 quarters. And the tailwind ongoing would be greater adoption and demand for AI, especially with US government unveiling their AI action plan in July. And also because of the strong second quarter earnings, there's definitely renewed interest in AI. So that's all for Magnificent Seven. I'll pass the time back to Iqbal.
Thanks, Helena. I'll be presenting on Frencken's first half results. Yeah, next slide, please. Yeah, so for Frencken, their first half revenue and PATMI is within our expectations. This is being driven by semicon revenue. As you can see in the table on the left-hand side, semicon revenue increased 42% year-on-year because of rebound in sales in Asia operations, and also because they are still experiencing stable sales growth to a key European customer, also known as ASML. Yeah, so for the second positive for Frencken itself, their medical and industrial automation segment are also experiencing higher demand. For the medical segment, it increased 6% year-on-year because of higher customer orders in Asia. For industrial automation segment, it increased almost 2 times year-on-year because of increased orders from a key customer. However, for industrial automation, their contribution is still quite immaterial because currently it makes up about only 5% of the second quarter revenue. For the negative wise for Frencken, Europe is experiencing higher operating costs, specifically labor costs. So this drags down on their gross margins. For their analytical life science product segment itself, they're also experiencing lower customer demand. Yeah, so this drags down the analytical life science segment by 6%. We maintain by our unchanged TP of $1.76, and we maintain our FY25 revenue and PATMI forecast because as you can see in the chart in the bottom left-hand corner, we do think that the decline in analytical life science and automotive segments should be supported by stable semicon, medical, and rising industrial automation segments. For outlook-wise, Frencken's management provided outlook for its semicon segment that demand will be more muted because of potential order volatility from its customers. Yeah, so mainly ASML and Applied Material. Based on ASML's earnings transcript itself, their earnings call itself, they did not provide the guidance for the next year's sales because they do see a lot of uncertainty coming from the tariff itself. And for Applied Materials earnings itself, they did mention that next quarter itself, they will face a slowdown in orders because their customer concentration is getting more specific and concentrated towards a key customer. So if the key customer cut certain orders in a certain quarter, they will also be affected. But their 1 and 2 year forecast is still very strong going forward. And we are still optimistic over the demand for advanced chip equipment over the next 2 years because of hyperscalers increasing capex guidance, showing the strong demand for advanced chips, as well as rising sovereign AI investments. Yeah, next slide, please. I'll be presenting on Hur's first half results as well, titled Firing from Multiple Cylinders because of the different contributions from their different segments. Yeah, so for their first half revenue and adjusted PATMI, it exceeded our expectations. And this is being driven by 158% year-on-year increase in property development revenue because Bartley View, which is their private condominium, they actually achieve 100% sales rate in the second quarter itself. Yeah, so this drives the revenue growth by 43% year-on-year. And they have also took in the sale of the PBSA Fund 1, and this contributed to the top line as well. For their positive, they achieved a record $629 order book in the construction segment. And this is being driven by the two recent contract order wins that they have secured from HDB BTO itself. And for their worker dorm segment, they added 20% more beds within the worker dorm segment in June itself. So for first half results, it is still insignificant contributions, but it will definitely contribute to second half results. And towards the fourth quarter this year, there will be an additional 47% higher bed capacity upcoming when the worker dormitory completes construction itself. Yeah, so and the last positive for Hur is that they have a healthier balance sheet from the sale of PBSA Fund 1, because as you can see from the table on the left itself, second last row, the net cash, they have experienced 32 million net cash now. As compared to 1 year ago, they are 113 million net debt. Yeah, so this is because of the proceeds from the sale of the business itself. And they are still expected to receive about 90 million more from the proceeds, and this is being reflected in their trade receivables. For the negative of Hur itself, we do see a lower recurring share of profit from joint venture after they sell off the PBSA Fund 1. And if you strip out all the PBSA Fund 1 segments as well as fair value losses, the adjusted PATMI has dropped 14% year-on-year, and this is because they registered a $6 million loss in terms of foreign exchange. Yeah. For Hur itself, we maintain buy. We raised our target price to 90 cents. Because we raised our this year's revenue forecast by 17% to reflect the condominium's 100% sales rate. And in our model itself, we removed Bartley View, and we included Hur's Australia properties with a combined net asset value of 110 million. So for the first property for Lowood itself, they have achieved their development application, which means that they are allowed to build up the property itself, and construction is currently underway. So this will be similar to Singapore's properties, where after they develop, then they will sell the property itself. Then for their second property, which is Kraina, it is a 2,000 unit property, and they are targeting to achieve DA by first half of next year itself. Our outlook for Hur is that this year's and next year's revenue and adjusted PATMI will be supported by the construction segment's record order book, as well as the worker dorms 67% increase in bed capacity by the end of this year itself. And overall in the industry, the higher target flat completion by HDB as well as the progress of major construction project will boost demand for construction and worker dorm segments. Yeah. Next slide. Thanks. Yeah, I'll be presenting on BRC Asia's third quarter update. So in this update itself, they provided limited financials, but yeah, so for their 9 months revenue and PATMI, it is within our expectations. It is around 70% of our forecast. The positive for BRC Asia is that they recently secured a 570 million Changi Airport Terminal 5 contract, which boosts their order book to a record $2 billion. And they are also experiencing higher project offtake and still delivery volume, which we estimate to be about 22% year-on-year. And this drives the highest revenue growth since first quarter of last year itself. And for our call for BRC Asia, we maintain accumulate. We raise our target price to $4.10. And this is because we lower our WACC to 10% because of higher visibility from the record order book. If you can see from the chart on the bottom left-hand corner, the trailing 12 months contract awarded, which is the blue color line, it rose by 38% year-on-year in June. And progress payments also rose 10% in June itself, which is the red color line. So we do believe that as companies get contracts awarded and they start progressing with their projects itself, they will need steel rebar, which BRC Asia has a 60% market share in. So we do believe that going forward, we think that they can continue to secure more contracts, even though the Terminal 5 contract is more of like a one-off because it's very big, but you cannot really expect this kind of recurring kind of contracts. It will not be so big going forward. But other construction projects such as MRT expansions, HDB BTOs, as well as some hospital contracts will still continue to take place. So we do expect to see further contract wins for BRC Asia. Yeah, that's all from my end. I'll hand over the time now to Miao. Thanks.
Yeah, thanks, Eben. Yeah, I'll present on SET's first quarter result. So first quarter 26 PATMI rose by 9.1% year-on-year, which outperformed our expectation at 30% over our FY26 forecast. And this is underpinned by strong cargo demand due to front loading activities, and cargo tonnage actually surged by 10.4% year-on-year. Yes, this is one of the positives of the result. So gateway service revenue reached 1.1 billion, which is an 11% year-on-year increment. And the growth was fueled by further expansion following new contract wins such as Cathay Cargo, Cathay Pacific, and Emirates. And SETS also remained positive on the cargo outlook, driven by strong demand from Europe, particularly Spain. With the new facility, they do have a new facility in Spain, and the utilization actually doubled. Yeah, so in first quarter 26. And US cargo market definitely become soft, like as expected. The volume dropped at quarter-on-quarter. And SETS is planning to mitigate this by securing orders from domestic express services like DHL, UPS, and Amazon, to offset the impact from cancellation of the de minimis exemption. And we still see margin maintain resilient for SETS, and it actually really stable year-on-year at 18.7%. This is due to the decision to retain manpower to buffer against potential cargo volume surge in view of the ongoing tariff uncertainties. And we do expect EBITDA margin to maintain at the current level for the remaining FY26. And for negatives, it is mainly centered around the non-aviation mail. So the food, even though food solution revenue from food solution grew by 5.6% year-on-year, non-aviation mail actually the volume declined by 10.6% year-on-year due to consolidation of Central Asia inclusion into Tianjin. However, SETS is confident that they can achieve break-even utilization for China Central Asia by the end of this year, as they have secured some new orders, major order wins, such as Starbucks China. And they're also expanding Central Asian capacity in Thailand by 5 times, and is currently running at full utilization. So we expect revenue from food solution to grow by at least 7% in FY26. And for outlook, the growth is expected to be driven by the European market, which is contributing to 20% of the group's top line. And this market saw 21% year-on-year surging revenue in first quarter 26.
Myanmar, can you improve your volume? Cannot hear that well.
Yeah. Hi, can you hear me? Is it better?
Yeah, maybe speak a bit louder or nearer.
Okay. So around 5%, yeah, I'll just Yeah, so around 5% of the group's revenue is expected to come from e-commerce segment. Yeah, so this is going to be tapering off due to cancellation of de minimis. Yeah, and Seth noted that there is still strength in the high volume e-commerce and also a surge in technology related products. Yeah, so this is underpinned by strong AI demand. And furthermore, like freight rates is anticipated to be supported by persistent like flight conversion blockage and also like perishable product demand. So we do maintain a buy call. We downgrade from a buy to accumulate due to recent share price performance, and with a higher DCF back target price of $3.66. Yeah, next slide, please. Yeah, that's all for sets. Next slide, please. Yeah, so I'll be presenting our aviation monthly. In July, there's actually mixed performance for aviation industry, and the small to mid caps is mainly supported by EQDP program, with CAO leading the performance, increasing by 26% year-on-year, and also SIA and SIE saw some correction, declining by 10.5% and 6% respectively. Yeah, next slide, please. Yeah, so SIA's passenger traffic in August rose by 6.2% year-on-year. This is outpacing the 2.8% year-on-year increase in capacity. And passenger load factor improved by 2.9 percentage point to 88.5%. Yeah, next slide, please. Contraction month-on-month. Sorry, is it on the next slide? Yeah. Cargo did see some contraction month-on-month, so it decreased by 0.3 percentage point month-on-month. And the cargo load rose by 2.1% year-on-year, slightly lagging the 2.7% year-on-year increase in their capacity. Yeah, so overall load factor declined by 0.3 ppt. Yeah, next slide, please. Also, for the outlook, IATA project passenger growth to ease by 5.8% year-on-year in FY25, and this is a 4.8 percentage point year-on-year decline. And we also expect cargo volume to drop. Yeah, so this will be slowing down to 0.7% year-on-year increment in 2025. Yeah, so this is weighting down by tariff and also the removal of de minimis exemption. Yeah, the headlines, airline industry profit is resilient. Yeah, even at supported by lower fuel price and also like higher load factors due to capacity constraint from the ongoing supply shortages. And for SAA, we expect forward booking to remain healthy for second quarter 25, with less front loading activities to support the cargo front. And for sets, yeah, as mentioned, we expect cargo to remain robust for the high volume, for the high ticket size item, for the e-commerce side, and also European will be supporting the overall cargo growth instead of like a US market. And for CAO, we remain positive, mainly due to the net cash position of 550 million, which is around 66% of the total market cap. Yeah, next slide, please. Yeah, that's all for transportation monthly. Yeah, I'll be presenting on Thakral Group, which yeah, I'll be covering Darren. Yeah, next slide, please. So first half 25 had me surged by surged by 912% year-on-year, which is far exceeding our expectation and reaching 350% of our full-year forecast. And something positive is Gem Life is successfully listed on the Australia side, ASX, and the IPO price is 4.16 per share. And the group also recognized one of the unrealized valuation gain of 102 million. Yeah, and following Gem Life's acquisition, the area portfolio development pipeline has expanded by 51% over the next 10 years. And the next positive is for the beauty segment. There's actually 33 new stores open in first half 25, including 27 outlets under the newly added healthcare brand. And DJI's broadened range of like action cameras and also accessories continue to perform strongly, and we also expect this possible business to turn profitable by the end of in the third year. And for outlook, the beauty tech group is preparing for its potential IPO, which could unlock further value for Thakral, and the value is expected to be at 70 million on their book. And also the beauty business aim to expand its portfolio to new like retail stores in Greater China to capture the rising demand in the region's beauty industry. As such, we do maintain a buy call with a higher sum of parts target price of $2.12. Yeah, next slide, please. Yeah, so that's all for Thakral. Yeah, next slide, please. Yeah, so this is Singapore REITs monthly. Yeah, and for July, actually REITs index rose by 2.4% year-on-year, rose by 2.4%, exceeding the 4.1% rebounded in the previous months. And the top performer for the month is actually CapitaLand India Trust, which rose by 13%. And the worst performer was Capital Pacific Org, fall by 4.5%. And among the subsector, overseas retail was actually the best performer, rising 7.3%. And Singapore retail was the weakest, falling by 0.8%. Yeah, next slide, please. And with the 3-month SORA easing further to 1.68%, as of 22nd August, the lowest since like September 2020. As REITs with higher SGD loan exposure and floating rate have already benefited. Yeah, and the figure below is a summary of like first half 25 result and year improvement in funding costs across like different as rates, and those like highlighted in green indicating the risk that is reporting a lower cost of debt year. Next slide, please. Yeah, so the graph here is 10-year dividend yield spread. Yeah, we believe 10-year dividend yield spread is actually growing back to the historical average. Yeah, so now buying REITs is have a more attractive compensation compared to invest into fixed deposit. Yeah, next slide, please. Yeah, so the graph on the so the graph on the left is forward dividend yield, and currently S-REIT is trading at forward dividend yield spread of 3.7%, which is 0.2 times standard deviation below the historical mean. and also price to AAV of 0.91 times, which is one standard deviation below the historical mean. Yeah, so we do see an attractive entry price despite the recent share price rebound, and this is supported by the prospect of further rate cut. Next slide, please. So for the subsector, we remain overweight on retail subsector. Yeah, so this is our retail sales index from 2019 to 2025. And for retail subsector, there's actually a mixed view in the first half result. So retail reversion do remain resilient, ranging from high single digit to low teens, with retailers such as Oyo East, Mandarin Gallery achieving 34% year-on-year for its retail rental reversion. And tenant sales were broadly similar, with softness in discretionary in the discretionary sites such as luxury goods and also fine dining, which is showing softness. And also there's still challenges in the cinema industry, such as MM2. And looking ahead, we do expect tenant sales to be supported by rising international visitors arrival and also CDC voucher. And occupancy costs remain slightly below historical average, with limited new retail supply. So outlook for positive rental reversion is still favorable, and we do anticipate high single digit to low single digit rental reversion. Yeah, next slide, please. We have a overweight for hospitality subsector. Yeah, even though like first half 25 showing a slight softness for hospitality subsector, with most REITs reporting mid-single digit to mid-teens year-on-year RevPAR decline. And this is coming off from a strong 2024 base, supported by major concerts such as Lady Gaga. Nevertheless, like international visitor arrival still rose by 2.5% year to date. And we expect FY25 arrivals to recover back to around like 95% to 100% of pre-COVID levels. Well, ADR have also moderated slightly. The anticipated growth of visitors' arrival should support higher portfolio occupancy, and therefore we maintain our forecast of a low single-digit RevPAR increase in FY25. Yeah, so that's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Mel. I'll move on to the technicals. Yeah. So first slide on the S&P 500 last week, we saw a weekly gain of 0.3%. So in terms of the chart, it's still holding the very important 30 SMA as a support, which is a yellow or orange line you see in the chart since June this year. And overall, the index is trending higher within the rising wedge. So I think this week, we are likely to see the higher high being formed to test the next resistance at around 6,500 to 6,550 area, while the short-term support is likely to be at 6,400 to 6,440 area, which is around the 5 and 10 SMA levels, which is the blue and red line you see in the chart. So and then the next one, in terms of the summary of technical calls initiated last week, the buy call for Genting has not been triggered yet. As for the buy for Oscar Health is currently in progress, up 0.9%. As for buy for Semcon Industries is currently in progress as well, up 0.33%. Yeah, so that's all from me. I'll hand over time to Paul to bring us through HRnet's results.
Yeah, thanks, Dean. So I have 4 results to go through. I think still have some more to do, but wait for the analyst briefing. So for first, for HRnet, there were some pockets of growth in the first half results. Next slide. So the results was within expectations. There is the you will notice on the left the adjusted PATMI. You notice there was quite a huge jump of 24%, but this is not the trend line, because in their other income, if you notice on the left again, they have this huge government grant of almost 9 million. So there's a bit of pull forward of government grants. So just to remind everyone, for HRNet, because of the flexible staffing or temp workers, they actually do get a government grant. So this is part of the model. But the timing of the government grants can change. Sometimes it's pulled forward, sometimes it's a bit delayed. Like last year was delayed. But we think it probably pulled forward about 4 million. So don't assume 24% as the kind of growth rate. The positive that they mentioned, professional recruitment is where you hire executives and so forth. That business has been deteriorating the last 2 years. But what happened is that they do see some recovery in North Asia, particularly in Taiwan actually, because of the jump in hiring for technology, especially semiconductors. The negative is Singapore. So Singapore is still very subdued. So the earnings is still down about 8%. Professional recruitment, which is hiring, has been one of the weak spots for Singapore for the last 2 years, a continuous decline. I'll talk about the opportunities later. So we maintain our forecast and target price. They still pay an attractive yield of almost 6%, and they are backed with a huge cash. I mean, they got almost 232 million. It should be 300 million if you add in the financial instruments, but because financial instruments, there are various types. Some are very liquid, some are not, so I just left it out. But if you add that in, you're probably about 300 million in cash. So the pocket of opportunity like we highlighted is in Taiwan. So they do see technology roles more in Taiwan. We get the feeling that as Taiwan, TSMC move more jobs into the US and they bring the whole Taiwanese headcount into the US, that's why there's a bit of a vacuum here in Taiwan. They didn't mention it, but I mean, this is anecdotally from speaking to people in the semicon industry. In Singapore, the opportunity for them is the demand for senior executives or CEOs, which is an ironic thing that even in a weaker labor market, there's actually demand for CEOs. So because of AI disruption and supply chain disruption, their clients are asking for more head of supply chain, head of disruption, which I'm not sure what that actually means, that role, but actually there's a head of country heads and so forth. So they are beginning to see more CEO roles. Of course, these are lumpy and a bit longer sales cycles, so it will take some time. Their focus used to be in the middle segment where the volume is higher, and also you can get higher churn, higher volumes. But because that's a bit more crowded, and especially with technology these days, I think they are focusing, moving up the chain to more CEO roles. On flexible hiring, we always view this as a multi-year opportunity. Because for them is to replicate what they have done very well in Singapore into China and Malaysia and Indonesia. So flexible hiring, the key thing for flexible hiring is really your financial resources, because you are technically paying the staff ahead, then you collect the staff salary later on from the customer. So of course you need a big balance sheet, and of course you need process excellence. You can't be doing this manually, so you need a lot of technology. So this is a multi-year growth driver. Next slide. Now for Q&M, we see more growth after the reorg. So there's a few things in play for Q&M. That's why the numbers, well, about single digit, but I think we're expecting stronger second half. Next slide. So for the first half results was within expectations. The revenue was about 50 and the profit was about 40. But even though we still within expectations because we're still looking at stronger second half. The adjusted PATMI, because they did have a loss from a loss on disposal of 4 million from the associate, so we stripped that out. So the positive was the employee cost is more stable. So that is important because I think the last few years, as they were expanding the clinics, taking on more nurses, more dentists, the employee cost was rising very sharply. So what has happened is also if you look at the table on the left, the dental clinics, net there's about 4 clinics new clinics they opened in Singapore over the last 12 months. But they actually opened 8, but they shut down 4 because they were closing some of the loss-making ones. So that's why you see, although they expanded the number of clinics, the employee cost is quite stable. The negative is Malaysia. So they actually outright shut down 7 clinics in Malaysia, because in Malaysia I won't say the joke, but anyway, there's a lot of clinics in Malaysia. You go to any mall, you see at least 1 or 2 dental clinics. So there's a lot of clinics, and that's why they are trying to to close the poorer performing clinics. So we maintain our buy. We actually raised our target price to 545. I think we are raising our valuations and bringing it closer to the healthcare sector with a slight discount, and our buy recommendation is maintained. So in terms of what to look out for in the second half, these are the few things. The first is if you recall, Q&M Dental. Sorry, for those who don't know, they're the largest dental chain in Singapore. They actually bought back their associate, the listed associate, housing, and privatize it. So after privatizing, you're going to see a lot more cost cutting going on in China. So I think they're going to need to right size the business there. So that will benefit the earnings. The second thing is, if you recall in the February budget, for chairs for senior citizens, actually the government has actually increased the subsidy for more complicated procedures, like crowning, dentures. Probably I'll do it one day, but dentures and so they actually raised the subsidy almost 3 times for some, to almost $400 to $500, I think. Yeah. So that will only happen in the fourth quarter. So you should expect the jump in volumes to come in the fourth quarter because of the tripling of subsidies, because everyone probably want to make use of that subsidy. They are also, of course, still undergoing this reorganization of shutting down the old clinics, I mean the poorer loss-making clinics, and opening up the new ones. So it takes time for the new clinics to ramp up. And the fourth driver to earnings will be the EM2AI. If you notice, I think the Prime Minister in the National Day rally did mention about the EM2AI. So this is basically an AI to, sorry for those who've heard this before. So with the AI scan, they can actually detect where are the problems, so that you have evidence-based treatment. So rather than listening to the dentist, which of course you can obviously trust the dentist, but if you want a second opinion based on AI, and this AI is unique because it's based on, or software is based on contribution for all their, I think, I don't know, 100 or 200 over dentists contributed to this software, where they would determine what is based on the evidence that they have, what is the best outcome or recommendation for the patient. So they did do a deal, I think, few months ago, to roll out this in 1,000 plus clinics, or 1,001 in Singapore, Malaysia, Thailand. So of course it takes time to roll out. I mean, this is not plug and play. So they have to roll out these clinics in 1,000. So we're also looking forward to some contribution from this EM2AI. It is based on a per licensing, a per use. They probably charge a couple of dollars. Yeah. The next thing, sorry to keep this so long, but anyway, the fifth driver is they issued a Singapore $130 million note, which they will use to lower costs of debt and also to make accretive acquisitions, which I'm not sure when or how large and so forth, but that's why they're raising so much money. Next slide. So for StarHub, I know the title's a bit funny, but anyway, for StarHub, our view is you just eat popcorn and just watch the telcos fight among each other, so don't have to participate. It's like watching TV. Next slide. So for StarHub, the results were within expectations. The one positive is that they did see growth in broadband, because if you notice the table on the left, apart from cybersecurity, which is still loss-making and lumpy, mobile revenue is down year-on-year, 6.6. Entertainment, which is pay TV, also down. But broadband, you did see some growth. So why they're seeing growth is because customers are moving up the broadband higher to 3 gig, 5 gig, 10 gig. Maybe Mel also will be moving to higher broadband to improve on the connectivity. The negative is the mobile business, where you notice revenue is down about 7%. And it's still the more worrying thing for mobile revenue is because it is down also 3% year quarter on quarter. So once you are down quarter on quarter, this will keep on sliding. So what has happened is that for mobile revenues, StarHub 2 years ago used to enjoy 150 over million per quarter. Then last year was 140 over million. Now they're breaking the 135 million. So that's why we think mobile revenue and will continue to come down, because there still remains a huge competition or hyper competition in mobile services, mobile phone services. So the negative is the mobile phone drag, and you will notice the ARPU is down 13%. So when selling price come down, it will I mean, virtually go straight down to the bottom line. So this is the thing that we worry, and the competition is moving from just the prices to even roaming. Now they're giving more and more free roaming, which used to be pure profit for them. So we maintain our forecast at neutral, our target price all unchanged. Of course, the key question everyone was asking is when Simba or TPG acquired M1, will there be better consolidation, and what is the reaction of StarHub? So StarHub basically just said that they are still going to fight. They still want to ramp up their aggressive pricing despite the so-called consolidation. So from StarHub's point of view is that firstly, number one, the merger will take time. So in the meantime, everyone is still fighting with each other for market share. And then number two is that even after the consolidation, they're not sure what Simba will do. So in the meantime, just fight first and fight for market share. Because if you don't, then someone else might grab your market share. And number three, our own view is that actually Simba might come out leaner because Simba is known for like a low-cost mobile operator. So with this acquisition, they could actually get down the cost even lower and make them even more competitive. So and actually, StarHub actually brought down their guidance for EBITDA. So from stable EBITDA, they actually break down the guidance to 12 to 16%. So we still have a neutral. Actually, we're not sure why the share price is still holding up pretty well. Maybe because the dividends they are guiding is at minimum of 6 cents. So that could be the thing that's holding up the share price. Next slide. So for this is my last note. So for Hyphens Pharma, they had the results. So it's a bump in the road, and they're scaling up. So next slide, I'll explain later. So for those who are not familiar with Hyphens Pharma, they have two parts of the business. One is called specialty pharma. We probably won't be familiar with these products because they are normally sold to doctors, and the doctors will prescribe to us. Specialty pharma, their main markets is Vietnam and Singapore. Proprietary brands, maybe you are more familiar. They are the owner of Ceradan, TDF, and Ocean Health. So if you are familiar, that one maybe as a consumer be more familiar. So actually the results was below our expectations. There was a big write-off. They did 4 million on inventory and FX. The positive was the improving cash flow. So because of the massive swing, they had negative and then now positive. So the one thing that's happening for this company is the Vietnam. So Vietnam is one of the major markets, and the revenue collapsed almost 40%. Although it sounds a lot, but it's probably like 8 million and so forth. But what happened is that the channels in Vietnam has been overstocked. So that's why there's a bit of a bump in the road now. They have to wait for this destocking to happen. So how this happens, I think we all know. But just to reiterate, Hyphens will import these specialty pharma products like Sterima for the nose, and another one for I just slipped my mind is for the X-ray vision to X-ray to inject blood to inject ink. Sorry, to help see certain X-rays. But because they import, and then when then they will pass on these imports to their distributors, but the distributor has too much inventory. So that's why their sales is when they sell to the distributor, and then the distributor of course will sell it to the hospitals. That part is okay, but the distributor now has too much, so they have to wait until the distributor clears some stock before they actually sell through. And yeah, that's a very long explanation. But so actually, if you look at the bottom, their earnings, you notice is down 70% because they had this aging inventory of Sterima, and it is not obsolete. It's not that it's expiry date, but it's just that it's quite slow moving. So they decided to make some provisions. But even excluding that, the earnings is down about 21% because I think Vietnam is not ordering, so that's why you see this weakness. We lower our target price. We lower our earnings, but we actually did do this curious thing of raising target price because we actually moved our WACC numbers. We lowered our risk-free rate, so our WACC now is about 9%, which is still high, and the valuations are attractive in this kind of market, especially among small mid-cap. It's only 10 times PE. And this is a company that is scaling up, that has a consumer healthcare brand and also pharmaceutical presence, not only in Singapore but in ASEAN. But the one issue for them is because of the size. Because as they are scaling up, they are going to Cambodia, they're going to Thailand. So all this needs investments, and of course, you're not going to get any profit contribution, and all this will pressure earnings. I mean, if you are making like 10 million, you hire 5 staff, each staff 100,000, you already 500,000, you probably have to, your earnings already dropped, don't know how many percent. So just to give you an example of the scale, they don't have enough scale. So when they are growing regionally, all these investments will actually pull down the earnings. The growth drivers for them will be medical aesthetics, one area for them, of course, because more and more aesthetic clinics are being set up, and then they will sell into these clinics. Yeah, let me quicken it a bit. Next slide. Okay, I'll go through our usual weekly. Not much news. The only good news is that for RMC volume, which will involve Pan United, Hong Leong Asia, which is a ready-mix concrete. The volumes have been weak the first 5 months, but we're starting to see a big increase in June. US, there's nothing much. So the only data point that came out was the delinquency rate. So consumer delinquency rate is still at 2.76, which is a decade high, more than a decade high in the US, of course, not Singapore, luckily. Next slide. Okay, so in terms of our tactical views, of course, we all saw what Jerome Powell did. So thanks very much. So what he has done is, just to give you some flavor, what Powell has said is that interest rates are too high or so-called restrictive, and they warrant a policy adjustment. Although, yeah, so because of that, why he thinks he needs to adjust his monetary policies, because there's downside risk to employment. The downside risk is rising because of the last few months, the employment numbers actually collapsed quite sharply. And he thinks that tariffs are just a one-time impact to inflation. And he doesn't think the tariffs will lead to higher wages because the labor market is weak. Yeah, so, and that's why the market now is pricing a 90% probability of a rate cut. So I think a rate cut in September is a done deal. It should be 16 and 17 of September. Actually, the market discussion is now whether October and whether December there'll be another rate cut. For us, it will still be of a hawkish. He might actually still be cautious in cutting. Because one thing, if you listen to the Walmart call, you'll notice that Walmart said that they are replenishing their inventory, but the cost is rising each time they replenish inventory. So inflation is definitely happening in the US, but it's just whether how the Fed going to seize it. The Fed was a bit cautious in saying that they are definitely going to cut rates, is because there's still a few more data points. You're still going to get one more inflation read, you're still going to get more labor, and not all the FOMC members agree to a rate cut. So I think that's why you see a bit of cautiousness. But for the market, we see it as a signal of a rate cut. So how to play this? For us, for Phillip Securities, I think we still like the foreign REITs. If you listen to Darren and Miao, so we like the foreign REITs because, like Stornoweg, their yields are really high. I think you're talking about 8%. And most of these have been stress tested. I think why we say stress tested, like we highlighted before, in like Stornoweg European REIT, they suffered a war in Russia. Interest rate has surged when in Europe. Of course, now it's coming down, and of course, the jump in energy prices. But even then, Stornoweg still managed to run through with maybe like around 90% occupancy rate throughout this period. So for us, they've been stress tested. I'm not sure how many Singapore REITs can do this type of stress test. And the other thing is that if you look at many REITs, especially the notable ones like Mapletree Industrial, Mapletree Logistics, even though they are deemed local, they do go to their forays overseas with, I mean, it's pretty clear it's mixed results. So even though you buy Mapletree, you think it's local, but they are actually going to the US, they have gone into China. So you are getting overseas exposure by even buying through some of the local REITs. And also I think like Myanmar said, we like retail because of the rental escalation, and also the supply is very tepid. So rental supply of malls in Singapore is less than 1% for the next 3.5 years. The other stocks that will benefit are the asset managers. So asset managers or fund managers like Keppel and also CapitaLand Investments, mainly for two reasons. Because when interest rates are down, it'll be easier for them to raise funds. And when interest rates are down, they can actually do more transaction activity and earn more transaction fees. Of course, okay, then our final point, our tactical view is that the everything rally in Singapore has not ended. So we still do see a few more rounds of liquidity injection that will help, especially the small mid-cap. The 1.1 billion that was announced by MAS, we don't think the money has even been deployed into Singapore market, maybe partially. Some funds may not even have received the 1.1 billion yet. So that will be the first round of injection, the 1.1 billion not fully used. The second round of injection for Singapore market is, of course, the 3.9 billion that will be done in stages. the third round of injection from capital is that once this 5 billion is given, the requirement is that these fund managers raise more money. Of course, that one we're not sure how much they can raise, but again, it will be additional capital injection into the stock market. Then the fourth round of injection we see is that hedge funds are starting to come into the market. Because when performance and liquidity will attract more, will beget or kind of attract more and more liquidity and performance. So of course, when the market is up, the final guys who come in is of course the passive funds. Because when the market is up, then there'll be more indexing, more funds come out, and then the passive money will come in. So we still think there's more room to run in the Singapore market, especially small mid cap, because there's still going to be a few more rounds of liquidity going to be injected into the market. So you're going to get this virtuous cycle of re-rating of valuations. That's why you notice we keep on raising our valuations, because we cannot be naive and just think that, oh, if it's 10 times means it's 10 times, because there's going to be a lot of liquidity coming into the market. So that's why we're kind of raising our valuations. In terms of the events to watch will be Nvidia, BYD, and I think Alibaba is also there, but I didn't put. So for this week, some of the events to watch open to everyone is Daiwa House, Elite, and Micromechanics also, the semiconductor. For Micromechanics, because they have a semiconductor in the US, so do dial in and you can actually ask them how are they, because they're the only ones that have some presence in the US, a big presence in the US. Okay, next slide. Okay, I won't run through this. This is just the slides. The left is just the RMC demand. It was slowing, but starting to pick up now. Hopefully, they will bounce back stronger. And then this is just to show you the consumer delinquencies are picking up in the US. Next slide. Okay. I'm not the REIT analyst, but because I was doing this for a separate presentation. But let me just run through what the low interest rate means. So just to remind everyone, that the interest rates in Singapore has already. So in a way, if the MAS was the Federal Reserve, the MAS would have already done 5 to 6 rate cuts, because the interest rates have been down almost 1.5% in Singapore. So the key point here I want to show is that if you look at the rate line here, so this is the dividends. So as you remember, when Jerome Powell raised rates in 2022, the dividends for the Singapore REITs were still rising. So we didn't really feel it yet, but you notice the market reacted. So the blue line is the REIT index. The REITs were already starting to come down, although dividends were rising. So right now, what we do see is that we think the dividends, the red line, the dividends per unit for the industry will start to stabilize and start to pick up. And we kind of think that the REIT index has probably bottomed up and there's room to climb after that. So you don't have to wait until dividends start to rise up that the market will actually re-rate, because the last time round, once the interest rates start to be cut, I think the market will start to run with. Next slide. So okay, this is my last slide on the REITs. So if you look at this chart, sorry, very colorful, but the green means interest rates is coming. So what I did was I took the 8 largest REITs, your Mapletree, Keppel DC, and so forth. So if you look throughout the years, the market of course did well when interest rates are coming. When it's green means their interest rates are coming. Then of course 2022, when the Fed started to raise rates, you notice everyone's interest rates were started to turn red. No, it depends on which REIT hedged out longer term and which didn't. But what we do notice is that it's starting to turn green again in the most first half or second or first quarter results, depending on which REIT's financial year end. So what we're trying to say, the key message here is that interest rates are starting to drop. And also then you will notice that the DPU will start to rebound. So although interest rate, you see although the yields might be 5%, but the DPU might grow. So the yields will start to climb back up again. So that's why we think REITs look attractive right now. Next slide. Yeah, okay. This is my last slide on the Wilmar. Yeah, sorry I talked so long. But anyway, Wilmar is a 19 billion company or less right now. They are in palm oil refining plantations. The financials was basically the net profit was down about 4%. I won't run through everything, but I think for us, my final comment is just that nothing really exciting for Wilmar. The one that is doing well for them is plantations. But if you want to buy plantations, you might as well just go direct and buy the palm oil companies. The consumer and crush is performing well, but the one that is not doing well is the refining. So under the refining margins bullet point, they say it's challenging. And there's a reminder, there's a lot of court cases pending for Wilmar. So there is the cooking oil court case where they deposited 700 million. They're still waiting for the Supreme Court. There's also a rice quality court case which is still under investigation. So these court cases are also another overhang on the company. And of course, there's also the land holding. It's not a court case, there is the land seizure by the government, which Wilmar wasn't explicitly mentioned, but there's always the threat that the government might take back some land from some of the plantation companies. Yeah. But any of the questions, yeah, I'll just answer because it take too long already. Yeah. Thanks everyone. Now move on to
Hi, thanks, Paul. I'll take on some questions. The first one is Hong Leong Asia's share price run up closely linked to BRC's good run, primarily due to shareholding Hong Leong Asia has. How about the performance of Hong Leong Asia's good business in China? Yeah, I think to answer your first part of your question, I think there will be some relations into whether it is linked to BRC's good run in terms of stock price. But however, the main bulk of Hong Leong Asia's business is still is still the China segment itself. They sell diesel engines in China, so that forms about 80% of their revenue. Yeah, so you're right in terms of the good business in China now propping up the share price. Yeah, because other than China gaining market share in terms of the diesel engines, they have also been experiencing growth in terms of the generator sets. So they are selling more generator sets in this half itself. And these generator sets can be used in data centers as well as hospitals, because these two crucial infrastructure are where power needs to continuously run. For example, in hospital, if you have a power trip, then it's very critical that you get it back up. That's why there's demand for their generators. And yeah, and recently they have been able to sell significantly more as compared to the past 5 years. And it has been a significant revenue contributor, even though they did not break down the revenue. Yeah. So that is what led to the good revenue performance in this half. Okay, take on some question. Any thoughts and prediction on NVIDIA earnings coming out on Wednesday? Time to accumulate or too late? Yeah, I don't think that NVIDIA will continue to break its revenue guidance, because they have been exceeding their revenue guidance for the past many quarters. I do think that their earnings will still perform well, because the drivers actually also mentioned earlier, it will come from higher capex guidance from hyperscalers, as well as the higher sovereign AI investments. For example, Saudi Arabia and UAE, they have been announcing bigger investments, as well as investments coming from Europe as well, the European Commission. Yeah, so I do think that their earnings will do well. It will be slightly impacted by the China segment, because previously, from the last quarter itself, they took an inventory charge because the US government banned the H20 chip sales. But then now they revert it. But however, I do think that similarly to AMD itself, there will be a lag time before they can assemble back the chip and then sell it to China. Because for AMD itself, a lot of the chip inventory are still work in progress. So for AMD itself, they guided that they will need 1 to 2 quarters before they can assemble the chip rack itself, the inventory for China, and then sell it to China. Yeah, so I do think that there will also be a lag for NVIDIA as well before they can get the China revenue segment back and running. Yeah. Whether it's time to accumulate now, I think in terms of valuations, NVIDIA is slightly on the premium side as compared to the Max 7 companies. But however, as I mentioned just now, even though among the 6 companies excluding NVIDIA, Meta has the highest revenue growth of about 20%. But NVIDIA is leagues above Meta. NVIDIA's revenue growth is about 60-70% over the past few quarters. Yeah, so I think this quarter itself, it will be slightly impacted by China, but I think it will still be about 50+% year-on-year growth. Yeah, so in terms of valuations, I do think that Nvidia there will still be room for growth, even though it is slightly on the premium side. Yeah. I think there's one request. Can show again the slide on the last page of Max 7. I think Sein can show. Thanks. Hi Ben, what is the reason for Frencken recent drop and doesn't seem to be recovering? Yeah, after their earnings itself, the price dropped a bit because I think a lot of attention on Frencken is about their semiconductor segment. And for this quarter itself, management guided that for the next half of the year, semiconductor segment will be stable. But however, from the previous guidance itself for semiconductor, it was that the semiconductor segment will be rising. So there is this change in tone from management. And however, I think overall for Frencken itself, I'm still optimistic for Frencken because of reasons stated earlier, that there is still very strong demand for advanced chip, and they are supplying a very key component for their major customers, ASML and Applied Material. So and also compared to their peers itself, Frencken is also currently undervalued. I think based on historical PE, they are trading at about 16 times. But the average in the industry, for example, UMS, AEM, and you also add in Grand Venture Tech, the average is about 28 times historical PE. And Grand Venture Tech actually got acquired for a valuation of about 29 times. Yeah, so we do still see upside in Frencken in terms of their chip valuations. Yeah. Hong Leong Asia has risen sharply. How far can it go? Yeah, in terms of how far can it go, I look at the valuations. It's about slightly more than average if you compare it to building material companies. For example, you bring in Penn United, bring in BRC Asia. It is about average and slightly at a premium. But I think in terms of how far can you go, I think because of the cycles, we do see the future cycles of re-rating, as what Paul mentioned, because of the liquidity injection from MAS. So I think going forward, that it still definitely has room to run. Yeah. There's a question, what is Hur outlook? I think Hur for construction segment itself, we are positive because HDB actually revised their guidance to be more positive in terms of the number of BTO flats being built. And Hur specializes in, based on their track record, they did quite a lot of HDB contracts. So we do think that it's possible that they can secure more. For their worker dorm segment, because there is a 67% increase in bed capacity by the end of this year itself. So and we do see increasing demand for worker dorm because of the major projects have just kick-started. So going ahead 1 to 2 years, we do see demand for worker comms still going up. Yeah. So I think that will form the main bulk of Hur's recurring income. And then the additional boost will come from maybe their Australia property development and remaining Singapore property development. Yeah. There's a question, how big is Hong Leong Asia's cement business compared to Penn United? I know they are 80% China diesel engine business. Yeah. I think to answer your question, I think you're asking more in terms of industry market share, if I interpret it correctly. Yeah, so for Penn United, their industry market share for ready-mix concrete is 40%. And for Penn United's first half revenue itself is about 400 million. For Hong Leong Asia, add up their cement and ready-mix concrete revenue is about 230 million. So I think that translates to about a 20+% market share as compared to Penn United's 40%. So I think it's slightly smaller than Penn United. And this 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 cement business will make up about, yeah, right, in terms of their revenue segment is about 20% of their revenue. Yeah. Yeah, there's a question. Lamchang Creations, ComfortDelGro, and CapitaLand has got recommendation for buy. Yeah, we don't cover Lamchang Creation, but I can give some intake and leave the question here for ComfortDelGro and CapitaLand has got. Yeah, so for Lamchang Creation, they specialize in restoration as well as A&E for the very old buildings in Singapore. For example, the Chinatown shop houses that need restoration. And also their main form of growth will come in from the conservation of very old buildings. So recently there's been more attention on conservation. So recommendation for buy, I think if you want exposure into construction, there's better construction companies out there. Like for example, building material, you have BRC Asia, Pan United. And if you want pure play construction, you also have a much bigger company called Soybuild. Yeah, so Lamchang Creation, I feel that it's still quite small. Yeah. So there's more suitable stocks out there that if you want exposure into construction. But of course, if you want exposure into the conservation space, I think Lamchang Creation is a good pick. Yeah. Yeah, okay. Last two questions. What does it mean by buy or accumulate? Yeah, so for buy, we see more than 20% upside in terms of our target price and their current stock price performance. For accumulate, we see 5% to 20%. And then for buy, we see more than 20%. Yeah, so if it's a buy call, that means we are more optimistic. Then for accumulate, we are less optimistic as compared to our buy call. Yeah. Yeah, that one answers the two questions. What is the target price for Hur after their last company presentation? Yeah, we just released a report this morning. I think you can go and take a look. But our target price right now, we revise it to 90 cents. Because in our model, we included their Australia property segments valuations. Then we also adjust it to take out the Singapore's condominium. Yeah, so we raise our target price from 55 cents to 90 cents. Yeah, that's all from my end. I'll hand over the time now to my colleagues. Thanks.
I'll answer the questions about Meta and Gemini. So the first question from Ian is that with Meta outsized investment into AI super intelligent team, do you think that the runway to monetizing AI investment will bear fruit soon, anytime soon? What's the timeline? Yes, I actually think that the benefit will be indirectly because the super intelligent team is actually aiming to improve Llama, which actually helps to support the AI recommendation model. So, I mean, on the short-term basis, we actually do think that it will continue to show on the strong ad business result because for the latest earnings result, I mean, the user engagement, this actually shows in the increased time spent across all platforms such as like Facebook, Instagram, and Threads continue to grow. And also it actually helps with the precise ad targeting. Like I say in my presentation, Meta actually has a very positive trend on the average revenue per user. And I want to emphasize of this precise targeting because this actually is an indicator that they actually provide a good ROI for advertiser because it means that it's efficient enough for them to drive the return. So instead of the advertiser actually use it because it's the massive user base, but because of the recommendation model, they can do the precise targeting, and this is why it's more efficient for the advertiser to get the return on the ad spend. And then regarding to the short to mid-term basis, Meta actually aiming to automate advertising actually using the AI. The company actually mentions that there are currently like nearly 2 million advertisers, which is like 20% of the overall advertiser worldwide are actually now adopting their Gen AI power video generation tools. And they do see it will encourage more ad spending from small to medium size advertiser, which is quite a big group within this advertisers pool. So we think that on the longer term basis, because of more access to this platform, it will actually benefit Meta ad business on the longer term basis. And then the next question is, do you expect AI chatbot Gemini to cannibalize their Chrome search engine in terms of ad revenue? At the moment, I don't think so. I mean, besides being quite sticky in terms of the user behavior, currently we don't actually see the user actually choose one over another. So in the second quarter for Gemini, the daily requests actually grow 50% from the first quarter, and they're actually asking for a longer and more complex query. But then at the same time, AI overview in search actually continue to drive 10% more queries globally. So this is why we don't think that are choosing one another. And I think on the longer term basis, these two services actually will be good in complementing each other in order to make sure that the ecosystem can be complete and for more efficiency, which I think is also a goal for Alphabet as well. I hope that answers your questions. I will pass the time to my other colleagues. Thanks very much.
Helena, you're muted.
Oh, sorry. So I was answering the question about which S-rate ETF would you prefer. So currently we cover 4 of them. They are the Phillip S-rate ETF, the Nikko AM Straight Times, Asia X Japan Rate ETF. Sorry, the name's a little bit long. Then we got the Phillip SGX APAC Dividend Leader Rate ETF and the CSOP iEdge S-rate ETF. So it really depends on what kind of coverage you want. So for Phillip SGX APAC dividend. So obviously it's the APAC region. So the Singapore exposure was pretty little. It was around 30% that covers the Singapore, and Nikko AM Straight Time is around 60% coverage is Singapore. So if you wanted like a wider range, these 2 are the ones that you will consider. So if you wanted fully to be focused on Singapore rate, it will only be Phillip S rate and the CSOP S rate. So both of them are pretty similar in the composition of their ETF. If you want a very slight difference, the CSOP is a much smaller scale. But they actually have a slightly higher dividend and a slightly cheaper price. So that would be the one that we prefer more compared to the Phillip S-rate. Yeah, so I hope that answers your question. I'll pass my time back to my colleagues.
Okay, yeah, thanks. Let me just try to answer some. Hi, Paul. Is Q&M a good potential candidate for the 5 billion small cap investment by MAS? The other one was sorry, I'm just trying to combine the question. For Q&M, the bond is not faring well, and there was another one. Would the other one was the Q&M selling it to Lion Global? Yeah, okay. Let me just try to answer some of these. So in terms of so Q&M sold, or the major shareholder Qingming, who I pronounce it correctly, sold about 20 million shares to Lion Global at 45 cents. So we take it as a positive. Because even before, because Lion Global is probably one of the contenders for the 5 billion, and even before receiving the money, they've already started to buy a small mid cap, and I guess in a way, they also recognize the whole re-rating underway. Again, I'm putting words into their mouth, but we see this as a positive. What Qingming bought, I don't have the exact pricing, but I think they started buying the shares recently when it was about 30 over cents. So they bought at 30 over cents and sell at 45. And they continue to buy again, I think the last disclosure. So I think it's a positive that you have the major shareholder continue to buy, and they also have share buyback. So I think it's a positive. I think Q&M has mentioned that they're going to do aggressive share buyback. I wouldn't say aggressive, but they did commit to a share buyback program for Q&M. So whether is it a potential candidate for the 5 billion? We think it is. I think healthcare assets, there are not many in Singapore, and not many that are growing. Of course, there's Raffles Medical and IHH, but these are the large ones. But if you want small mid cap, then it will be Q&M. Another one is Thomson Medical, but of course, their Malaysia business is not performing well in the very near term. I hope I answered that. I'm not sure if I did, but anyway, Paul, can Micro Mechanics leverage their position in the US going forward? So I don't have an answer for you. So that's why I'm interested to get an update. So there are two things. So for Micro Mechanics, for those who may not know, they are in semiconductor, they're in the back end. So they actually do this very unique thing where, you know, in a wafer, sorry for those who may not know, in the semiconductor, the wafer, like a frisbee, the black thing, and then you actually have to cut it into little small dies that goes into your phone or whatever. But to pick that little small die that is probably so tiny in centimeters, there's a rubber tip attached to it, and this rubber tip needs to be really fragile, needs to be anti-static. So there's a lot of material science in what they do, and also precision engineering. So that is the old business, the current business that they do, but that's very volume driven. So you need volume to grow that business, and I don't think volume is doing that well for the whole electronic business. Not like smartphones are really skyrocketing. So, but the new business that they're doing is in the US, which is the front end, like what Frencken is doing, and so they are moving to front end because margins are better and higher barriers to entry. So I don't have an answer for you, but the key thing to watch is how US is doing, because this is a completely new product line for them. They did done it the last 2-3 years of revenue, but this is where the growth is. And the key thing to us, because this is a very dynamic thing, is whether with the tariffs, whether are more and more customers approaching them. Of course, this is not like Intel putting money into, not like the US government put money into Intel. Doesn't mean the technology is going to do any better and customers will approach them. But this one, this is really because they are already there. They have the track record, so they might get customers approaching them because they have already a base. Like if TSMC were to be there, then no, they are one of the very few manufacturers. So if the supply chain moves into the US, they should benefit on paper, but need to get an update from them. Any thoughts on ST Engineering overvalue? We have a target price of 820. But I think the reason which I did type out was because before the results, I think this stock was trading about almost 38 times historical PE. So the expectations is very high for this stock. So I think I think that's why the share price is probably the best performing stock on STI, almost doubled. So I think there's a bit of gestation. And number two, although there's a big re-rating because of defense, but I think like I highlighted before, only 40% of the business comes from defense. So I know the whole military, all the military stocks all skyrocketed, but you know, this is not a totally 100% military company. So for me, I would rather just take a step back and then wait for the next results, because our preference for large cap is really Keppel Corp, because I think Keppel Corp's results, the operations haven't really turned around yet. So that one you will see the big earnings growth, especially next year. So for ST Engineering, we just worry that a bit of de-rating in the near term, because the earnings was within expectations, about although 18-19%, but if you have 40 times PE, then maybe your earnings cannot grow just 18-19 times. So I think there's a bit of de-rating underway. Yeah. Sheng Siong target price, new supply. I think this is a technical question. What's your view on ST Engineering? I think I answered that. US and Singapore markets seem already priced in this September rate cut. Your comments? I think only a little bit, because if you notice the US markets still rallied. Again, I don't have hard evidence for this, but if you notice the bond markets did rally, and also the equity markets in the US did rally. So it just shows that market is expecting. So the key thing is to watch. Everyone says it's more October and December. Just that with this statement, I think it's more likely he will also do a rate cut in October and December. You need to see the data. So if the jobs data is weak, the US market will rally, which is the kind of ironic thing. So there's something to watch. So I think the market is priced in, but I think now the market is putting a highly likelihood that October will do another cut. Because he said a change in policy is not just one cut. I mean, it's directionally it will change. But I think the key thing I want to emphasize is that it's not so much like how many cuts are going to happen, whether it's 2 or 3 or what. But most important is that directionally there's a high probability there's going to be more and more rate cuts coming. And because it's become very political. You know, Jerome Powell is going to be removed. So the politics will also drive the rate cut. So I can't tell you for sure how many rate cuts, but you just know that the probability is there, directionally is there. There's going to be a lot of rate cuts. I think that's the main message. I can give. Yeah. Okay. Let me hand it to Zain. I'll try to type out some of the questions so that Zain can answer the technical. Yeah. Sorry, I think we still got a lot of questions. I apologize, we can't take on all. But let me try to answer, type down. Yeah. Zain.
Okay, thanks for move to take some of the TA questions. Okay, so I think the first question is on China aviation. I think it is still trending up relatively well. So previously price was just broke out this range consolidation at 118, and then generally is holding support around the 5 and 10-day moving averages, the blue and red line. So I think we would likely to see a continuation of this trend. I think now the short-term support is around 125 to 127, this area. Yeah, so I think for now we might see some slight pullback with the volume coming down. Then I think once it retest this previous resistance, then we might see the uptrend continue on. Next one is on Everglory. So for Everglory, I think generally it's a uptrend. Then recently, I think near-term supports will be around one support level is around the 58 cents area, and then the next one is around 55 cents. But on the weekly itself, the retest of the 5 is currently trending along the 5 MA, which is around 5.58 cents. So I think there will be a support level for the price to bounce off. Then near term wise, we might see some range consolidation with resistance at around close to the 62 cents. Yeah, so after we might see some sideways. I think we might see some sideways price action for the time being. And for 579 Hong Kong, which is Beijing Jingneng Clean Energy, I think for this, I think the momentum has come down a bit, but overall it's still in an uptrend. Momentum come down a bit because price was unable to sustain above the short-term movement averages when you try to break above this 250 level. For now, I think we're probably seeing some range consolidation with support around close to 230 will be quite a strong support, which was previous reasons. That's why I expect price to just sideways by 230 to about 250 this area for now. Okay, then next one, what's a good price to buy Frencken Netlink as well as CapitaLand Escort Trust? Okay, first up for Frencken, I think it hit a support level around 140. So this was like a previous reasons as well. Recently broke out in mid-July. So I think that could be one level to consider. Then on the weekly time frame, yeah, this is around the 10 MA. So I think we might get some support over there. The next support, if it goes a bit low, might be somewhere around 132. Yeah, 132 over there might be a next support level. So over there, I think for now, maybe 140 price would just sideways a little bit. Around here might be a better entry after price has pulled back quite a bit for 170s. For Netlink, I think yeah, overall also in an uptrend over here. For now, a price to buy maybe somewhere around 90 cents, I think. Overall, since this was like a previous reasons of a range, April to August this year, then if it does retest, I think this will find some support. Price will find some support over there. And for CapitaLand Escort Trust, I think a price to buy maybe around 86 cents. If it does retest this previous resistance it broke out of in mid-July this year. The next question is on Keppel. Yeah, for Keppel, I think the current momentum is coming off a little bit, probably trading a bit sideways. Prices after this gap up over here, price action is coming off a bit, but it's still holding around the above the 20 MA levels, around 830 for now. So we might see some bits of sideways price action for the time being. Also now currently retesting the 5 MA of the weekly is around 835. Yeah, so I think we might see some sideways consolidation with support around $8. $8 will be quite a strong support, even at a psychological level, as well as the breakout at the end of July. And then for SIE, I think it's probably doing a bit of a consolidation right now. So I think after this sell price found some support around 650 around there, then it looks like it's doing a ascending triangle consolidation, trying to form a bit of higher highs with resistance around 665. So I think if price can try to break above this level, we might see some short-term bounce towards maybe around 673. Yeah, 673 to about 675 on the 10 MA on the weekly. So yeah, maybe we see some temporary bounce if price can break above 665. Yeah, for sets, I think probably sideways for now. Still generally trading between 318 to around this 336. Yeah. So price has been just quite sideways since end July. So if you can break out of this level, then next resistance probably around 352 around there. Then for SIE engineering, I think price is just still sideways for now. If you some weakness as this previous 318 level, the breakout over here, price breakdown, and then found resistance upon a retest. Now it's just still finding some resistance along the short-term moving averages. So I think it's a bit sideways more to the downside. Then on the weekly itself, also currently the 5 MA is starting to cut down below the 10 MA. So it's around 313 around this area. There's some resistance. So you might see some pullback in terms of the price, I feel. To test next support around close to $3 and then around 288 next. Okay, next one for Yangtze Shipbuilding, I think price is just is doing a sideways consolidation. So it looks like a bit of a bullish flag with key resistance around 292, then support around 282 over here for now. So I think it's just a bit of a sideways consolidation. Then if afterwards you can break above this 293, then we could still see more upside, maybe to test around 314 next. So the uptrend is still intact, just a bit of a consolidation in the short term. Next one for Zixing, I think price is rebounded from the retest of 0.029. Then it's just doing some sideways movement over here for now. Some resistance is at 0.032, and afterwards it's around 0.035 over there. So I think just a bit of a sideways for now. Next one, for Sheng Siong, I think it's retest. Currently doing some sideways as well. We tested this upward support line around this close to $2.04. Then it's just moving sideways. So I think if price can try to break above 210 afterwards, then we might see the uptrend continue. So it's just a bit of sideways consolidation for now. For Comfort Delgro, I think it's showing a bit of a price is showing some weakness over here, but just some pullback, I think. After hitting about close to 160, some support should be around some support should be around 140. I think that would be a good support, where previously this was a resistance level, and then this was a resistance level, and then it's close to the main ascending body formation support is trading in. So I think it could do a bit of a pullback towards 140 if it cannot hold 145 over. Next one is Keppel DC REIT. I think it's doing some sideways consolidation for now, but overall the uptrend is still intact. As price is still forming higher highs and higher lows. As long as this 228 level holds for now, then if you can break above 235, then we're likely to see upside ahead to maybe 240 and above. Then there's a question on Tesla. For Tesla, I think it's still positive, I guess. Price has been forming higher lows along the way, and then it's probably in this consolidation wedge over here. And as long as price can try to maintain above 327, I think after this back test over here, I think we could see some upside ahead to test the next resistance around 335 to 367 in the near term. Yeah. And for Semcon industry, I think price is probably just sideways over here for now. After the retest of this 200 MA level around 605, this purple line seems to have found some support, and then currently is in oversold. RSI around 29. On the weekly itself, I think it's 590 will also be around this area, will be a strong support. This is the 50 SMA on the weekly, which previously we looked back in the past 2023 as well, 2024, when there's some pullbacks. This has acted as quite a bit of support. So I think we could expect some sideways price action around the $6 area. Then if price can try to break above this 614 level, above that, then we might see some recovery for Semcon towards first level is around 635, then afterwards around 665 area. The next one's for city development. I think it's just the uptrend is still just continue to trend higher. So price is finding support along the 10 MA level, the red line, and then it's a higher high today. I think most probably we'll see the uptrend continue. Next recent level probably around 67, close to 720. Yeah, 720, then followed by around 745. Okay, then for Citrum, I think it looks like a bit of a consolidation taking place right now. Just price sideways consolidation with support is around 227, which is 10 MA on the weekly, horizontal level as well. Then possibly like a descending triangle consolidation. So we can try to hold above this 235 level, which is I think is a key horizontal level where this was a support breakdown over here, and then you can see some reactions over here as well. If price can hold above this level, then we might see some recovery to back above to test 240 and 246. Okay, then for yellow, I think it's showing some good momentum. So break above this 65 cents resistance level over here. Then price also on high volume as well, and then price is just doing a bit of a sideways consolidation after this strong move. So I think we likely see price trend higher afterwards, as long as it holds above the 10-day MA at least. So that's probably it could do some catch up towards 67 cents on the yeah. So after that, I think the next resistance to test would be around 75 cents to 77 cents area for yen lot. Okay, next one for CLI. For CLI, I think probably it looks like still sideways consolidation, but the good thing is that the price is holding during the pullback recently. I think price is holding above the prior resistance breakout around 265. So there's still previous resistance still holding as support. Probably we see some sideways action over here with I think in the short term 285 around there will still be some resistance. Yeah, so expecting some sideways after that. Then after that, the next resistance test is around 295. Okay, then there's a question for Frencken UMS and AEM. Which amongst the three, which one has a better TA outlook? So first one for this Frencken tested 140 already, holding there for now for this one is UMS. Yeah, UMS, I think for now 142, 144 area might have some resistance. Price tested the 140 level, but I think there could be some resistance over here. So I think not as strong as Frencken. Then for AEM, yeah, AEM, I think it's around the same as Frencken. I guess 140 over here tested this support level is just there's a bit of a bounce over there. Then but for price to resume back the momentum, I think we need to see a break out of this downward resistance around 150. So I will put Frencken and AEM in the same level, I think, in terms of the TA strength. Then UMS, I think, is a bit lagging behind. Yeah. Okay, then next question is on ST Engineering. Yeah, for ST Engineering, I think just continue on from pullback. Previously, very steady pattern over here where we have range consolidations and then a price breakout about to make higher high. And since the breakdown above below this 840 to 855 area, price coming down a little bit. So I think for now it's testing around the 100 MA level. So we see whether there's a bit of a support over there. Previously, there has been some support around this level back in 2024. See when it tested the red line price, and there was some support. So we could have some support over here. This is around 780. Yeah, given that this was also a range consolidation support around 760 to 780 area. Yeah, so I think for ST Engineering, we might see price start to do a bit of a sideways around this area as it comes closer to 760 to 780. Next one, Samudra Shipping. I think it's the uptrend is still pretty much intact. So this looks like a bit of a range consolidation, possible bullish flag between 97 cents to $1.04. So as long as if you can make a higher low over here, especially about the short-term movement, with just like $1, the psychological level as well. If you find support over there, then price can break above 104 afterwards. I think it's still positive for a higher high towards. Next resistance maybe around 140, yeah. For Samudra, I think still the chart is still looking quite bullish. Yeah, I'll try to take two more questions since it's close to one. Next one for Hur, I think after sideways consolidation after a strong rally, I think price is still holding some of the key levels like the 20 MA on the daily over here, and we are still seeing higher lows being formed along the way, like 63 cents, and then here is 65 cents and 68 cents. and multiple tests of resistance at around 73 cents level. So I think after this consolidation, you can break out above this today's high. I think we're likely to see continuation of the upside ahead. Yeah, I'll take one last question on Capital Ascendas Trust, Ascendas REIT, sorry. Capital, for Ascendas, I think probably some sideways for now. I think the support at 267 slightly to hold. This was prior resistance, and for now, since the price broke down the level around 278 to 280, there's likely to be a short-term resistance over there. So I'm expecting some sideways consolidation between 267 to 277, this area for the time being. Yeah, so that's all from me. I'll hand back the time to my colleagues if there are any more questions to take. Thanks.
Let me just try to do one or two. Then we just end it. Because I'm trying to type, I can't type so fast. What is the outlook for Singapore banks' fourth quarter with expectation of September rate cut? Do you expect loan growth to offset earnings from wealth management? Which bank to acclimate? Okay, our preference is still DBS Bank because they have a 6% yield. Even if they've already guided dividends of rising by 24 cents for 2026. So the dividend yield, if I'm not mistaken, if you add back the 24 cents, you're talking about 6% yield. So in terms of the interest rate margins, it is not so clear cut. There will still be pressure on loan margins, but the offset, I think, like you rightly mentioned, there'll be loans growth. Number one. Number two, there's more and more of the deposits going to CASA, which is zero interest, risk-free loan, I can call it. Deposits are essentially loans. So they are low, a lot of CASA deposits actually climbing up. So that will also offset some of the margins. And number three, what especially DBS mentioned is that they are collecting a lot of deposits. And what they're going to do is they're going to take these deposits and park into government bonds and earn a 1% spread. So even though net interest margins might come down, but net interest income will actually rise because there's just so much volume in deposits that they can still earn a sizable income from it. And then of course your capital markets, the strong capital markets and interest rate cut will actually benefit their wealth management business. Then I think what will happen is that their high net worth clients will, instead of parking money in FD, will want to get a yield pickup. So they will probably buy structured products. They will probably buy more funds or buy bonds. So the low interest will actually support a wealth management business. Because when their interest rate is 1%, I think even the rich guy also wants something higher, in a very not layman way of explaining. Yeah. So I hope that answers it. Yeah. Okay. Anyway, thanks. There was still a lot more questions. I try to type as much as I can, but no, do go into our community if you want to get some of these answers. Yeah. So sorry. We normally try to keep it at 2 hours. Otherwise, more than that, everyone's going to get bored. Yeah. Thanks everyone for your time and for especially the questions. And hope you have a good week ahead. And again, thanks for joining us and spending some time with us. I hope it was useful. Thank you, everybody, and have a good week ahead. Bye-bye.